This is an emergency broadcast, and before we even pull up the charts, I need you to do me a favor. Reach into your wallet, pull out a dollar bill, and stare at George Washington's face. Look closely. Does he look disappointed? Does he look like he knows his legacy is being traded for cheap plastic junk and terrible choices? Because he should. If you still believe that green piece of paper in your hand is money, you're about to get a lesson in physics that's going to sting. I need you to put the remote down, stop doom scrolling because the financial system is not fine. We have officially entered the phase of this collapse that historians will write entire books about. They won't call it a correction, they won't call it a recession, they're going to call it economic warfare. It is Wednesday, and the battlefield is no longer theoretical, it's mathematical. We are watching a dislocation in the global markets that shouldn't be possible. In a normal world where markets are efficient and connected, the price of an asset should be roughly the same everywhere. An iPhone costs about the same in New York as it does in London. A barrel of oil costs about the same in Texas as it does in Tokyo, give or take a few bucks for shipping. But today, the laws of economics have been suspended. We're looking at a split reality, and I need you to focus on the two numbers that define this situation. In New York, on the COMEX, the paper casino run by Western banks, the price of silver has been smashed down. They hammered it overnight. They threw every short contract they had at the wall. The price on your screen is hovering around $106. If you're a Western investor, you're panicking. You're thinking the bubble popped. Wrong. You're staring at the fake price. Now let's teleport 7,000 miles to the east. Let's look at the Shanghai Futures Exchange. Let's look at the market where people actually take delivery of the metal because they need it to build solar panels and electronics. The price in Shanghai is $126.95. Do the math with me. 126 minus 106. That is a difference of $20. That is a 20% premium. In the world of arbitrage, a 1% spread is a fortune. A 20% spread is a supernova. It's a financial black hole. It's a vacuum cleaner the size of a continent. Do you understand what this spread does to the physical supply chain? Imagine you were a silver refiner in Switzerland. You have a 1,000-ounce bar of silver sitting on your desk. You have two phone lines ringing. On line 1, it's a banker from New York saying, "I will give you $106 for that bar." On line 2, it's a trader from Shanghai saying, "I will give you $126 for that bar." Who do you sell to? You don't need a PhD in economics to answer that. You sell to the guy paying $20 more. You hang up on New York, you block their number, and you put every single ounce of metal you have on a plane to China. This is the mechanism of the drain. This spread absolutely guarantees the Western vaults will be emptied. It guarantees London, New York, and Toronto will be stripped of their physical assets. The metal flows to the highest bidder, and right now the highest bidder is the Chinese market. They're effectively sucking wealth out of the West ounce by ounce, bar by bar, and the bankers in New York think they're winning because they managed to smash the paper price down to 106. They're celebrating a shallow victory. Yes, you lowered the price, but you also guaranteed that you will have zero inventory left soon. You're running a sale at a store that's about to go out of business. This is not a market inefficiency. This is economic warfare. This is a deliberate strategy. Beijing knows exactly what it's doing. They're looking at the US dollar, which is crumbling, and they're saying, "We don't want your paper anymore. We want your assets." They're using the arbitrage to repatriate the world's silver supply to the east, and the West is letting them do it because the West is addicted to lower prices to mask inflation. But why is this happening now? Why did the spread blow out to $20 overnight? Because the dam holding back the US dollar has finally broken. The arbitrage bomb is just the symptom. The disease is the currency itself. We need to talk about the DXY. We need to talk about the dollar index crashing below 96. Because while you're worried about the price of silver going down in dollars, the rest of the world is worried about the dollar going down against everything. The floor is falling out from under the reserve currency. For 80 years, the dollar has been the North Star of the global economy. It was the constant. It was the ruler we used to measure everything else. But today, the ruler is shrinking. The North Star is burning out. We have just witnessed a technical breakdown that signals the end of dollar dominance. The DXY, the dollar index which compares our currency to a basket of foreign rivals, has just smashed below the critical support level of 96. It is currently trading at 95.8. This is not a dip. This is a structural failure. Year over year, the dollar is down 10.7%. That means if you held cash in a savings account for the last 12 months, you lost about 10% of your global purchasing power without spending a dime. You were robbed in your sleep. But to see the true damage, you have to look at the real money pairs. Look at the Swiss franc. The dollar is down 14.15% against the franc. Look at the euro. The dollar is down 12.15%. The world is dumping the dollar. Central banks in Asia, sovereign wealth funds in the Middle East, and pension funds in Europe are all hitting the sell button at the same time. They're rotating out of the reserve currency and into a multipolar basket of assets. And what is the one asset that is neutral? What is the one asset that has no counterparty risk? Silver and gold. Now, I know what you're going to say, but the stock market is at an all-time high. My retirement account looks great. I need you to stop looking at the number and start looking at the value. Yes, the S&P 500 is making new highs, but let me ask you a question. If a currency collapses, does the stock market go up or down? It goes up. It goes to the moon. In 2018, the Caracas Stock Exchange was the best performing market in the world. It went up thousands of %. Did the people get rich? No. And the stock market went up because the currency went to zero. That is exactly what is happening in New York right now. The highs in the S&P 500 are an inflation illusion. You're not making profit. You're just running to stand still. You're preserving your purchasing power against a dying currency, but you're not gaining wealth. This collapse of the DXY is the green light for Beijing. China has been waiting for this moment for a decade. They've watched the US weaponize the dollar. They've watched the debt spiral out of control. And now that the DXY has broken 96, they know the US is vulnerable. They know the Federal Reserve is trapped. If the Fed raises rates to save the dollar, they crash the economy. If they lower rates to save the economy, they crash the dollar. It's checkmate, and China is grabbing the board. They've launched a strategy that is so simple yet so devastating that Western bankers have no defense against it. They're not fighting with missiles, they're fighting with premiums. They're using their own paper currency to drain our physical vaults. Here's what the leadership has realized. They're sitting on a mountain of US Treasury bonds, debt that is rapidly losing value as the dollar collapses below 96. They're also sitting on their own printing press that can print infinite yuan. So what do you do if you're them? Do you wait for the West to default on its debt? No, you launch a resource raid. You deliberately allow and perhaps even encourage the price of silver in Shanghai to trade at a massive premium to the rest of the world. You let it hit $126. Why? Because you know the Western banks, in their arrogance, will try to suppress the price in New York to 106 to hide inflation. This creates the perfect trap. By keeping the price high in Shanghai, they turn their entire economy into a giant vacuum cleaner. They're effectively saying to the world, we will pay you more than the Americans. Bring us your metal, and the market obeys. We're seeing reports of bullion dealers in London, refiners in Switzerland, and wholesalers in Australia diverting their shipments. Ships that were supposed to go to New York are turning around in the middle of the ocean. Planes are changing their flight plans. Why would anyone sell to the COMEX for 106 when they can sell to Shanghai for 126? Capitalism is doing their work for them. The invisible hand of the market is stripping the United States of its strategic reserves and handing them to its greatest geopolitical rival. And here's the genius of the trade. They're paying for this metal with yuan. They're paying with paper currency they can print for free. They're trading paper for silver atoms, a strategic metal required for solar panels, electric vehicles, and advanced electronics. They're trading the infinite for the finite. They're giving the West the paper and taking the rock. But the empire isn't going down without a fight. The institutions in New York see what's happening. They see the drain, and they just launched a counterattack. It's a desperate, dirty, and dangerous move designed to stop the bleeding by force. They couldn't find more metal, so they decided to attack the traders instead. We need to talk about the margin hike. We need to talk about the $51,000 requirement they just put on every silver position in America. This is the part where we expose the dirty tricks, because when you're losing an economic confrontation, when your currency is collapsing and your vaults are being raided by a foreign superpower, you don't play fair. You cheat. You change the rules of the game in the middle of the fourth quarter. And that is exactly what the CME Group, the owners of the COMEX, just did. We have just received a breaking alert from the Exchange Clearinghouse. Effective immediately, the margin requirement to hold a single contract of silver has been raised to an absolutely staggering level. They have hiked the maintenance margin to $51,750 per contract. I need you to understand how insane that number is. A standard contract represents 5,000 ounces of silver. Usually, the margin, the down payment you need to put up to control that metal is around $10,000 or maybe $15,000. It allows traders to use leverage. It allows the market to have liquidity. But by jacking it up to $51,000, the COMEX is effectively detonating a financial device in the paper market. Here's how the system works. Imagine you are a hedge fund manager or speculator. You're holding 100 contracts of silver because you know the price is going higher. Suddenly, you get an email from the exchange. They tell you that by the close of business today, you need to wire them an extra $3 million in cash to keep your position open. You don't have $3 million lying around. You are fully invested. So what do? You have no choice. You are forced to sell. You have to liquidate your position, not because you want to, but because you can't afford the new entry fee. This creates a wave of artificial forced selling. It creates a liquidation cascade. Thousands of traders are closing their positions at the same time. And what happens when everyone sells at once? The price crashes. This is why you see the paper price in New York smash down to 106. It's not because supply and demand changed. Demand is higher than ever. It's because the exchange rigged the margin rules to force the price down. They're trying to paint a red candle on the chart. They're trying to scare you. They want you to look at the screen, see the price drop, and think, oh no, the rally is over, I better sell my physical stack. This is a psychological operation. It's warfare designed to break the spirit of the Western buyer. But here's the flaw in their plan. Here's why the strategy is doomed to fail. China does not buy on margin. Institutional buyers do not use leverage. The industrial buyers in Shanghai are not speculators. They're cash buyers. They pay 100% upfront. So when the COMEX raises margins, it hurts the New York speculator, but it does absolutely nothing to stop the Shanghai vacuum. In fact, it makes it worse. By smashing the price to 106, they have just made American silver even cheaper for the East to buy. They have effectively put the on sale sign up. Come and get it. We just lowered the price by another $5 for you. It's a self-destructive strategy. They're burning the furniture to heat the house. They're destroying the paper market's liquidity just to survive one more day. Meanwhile, we are witnessing a coordinated, well-funded smear campaign against silver across every major media platform. Suddenly, out of nowhere, you have experts who haven't mentioned precious metals in years coming out to criticize it. You have articles with headlines like, "Why Silver is a Trap for Retail Investors," "The Liquidity Myth," "Is Silver the New Bad Investment?" Do you think this is a coincidence? No, this is a script. They're terrified. They know that if the American public wakes up, if even 1% of retirement money in this country moves into physical silver, the game is over. The COMEX breaks in an afternoon. So they have to scare you. They have to gaslight you. They have to point at the screen where the price has been manipulated down to 106 and say, "See, it's crashing. You better sell now before it goes to zero." But here's the rule for surviving an information battle. Ignore the pundits. Listen to the producers. Don't listen to the guy in a suit on TV selling paper derivatives. Listen to the guy who melts gold and silver. Listen to the refiners, because while the media is screaming sell, the biggest refiner in the world is screaming we are empty. We have just received confirmation from PAMP Swiss. For those who don't know, PAMP is the gold standard of refining. If metal is moving, PAMP knows about it. And what did they say today? Did they say demand is soft? Did they say investors are selling? No, they said we're seeing demand at levels we have really not seen before. Think about what that means. They've been in business since 1977. They saw the squeeze in 1980. They saw the financial crash of 2008. They saw the squeeze of 2011. And they're saying that today, right now, in January 2026, demand is bigger than all of that. They're running their facilities 24 hours a day, 7 days a week. They're paying workers triple overtime, and they still can't keep up. The backlog for wholesale delivery is now stretching into April. If you order a bar from PAMP today, you're essentially buying a future. You're buying a promise that maybe, just maybe, they'll have a bar for you in 3 months. This is the reality on the ground. The physical market is on fire, the shelves are bare, the refiners are overwhelmed, and yet the paper price on the COMEX is down. The price is 106. It's a lie. It's a malfunction for the financial system. The computer is telling you one thing, but the real world is telling you the exact opposite. This disconnect is the ultimate signal. When the price drops but the shortage gets worse, it means the price mechanism is broken. It means the price is no longer a tool for discovery, it's a tool for deception. That 106 price tag is a gift. It's the system subsidizing your purchase. They're practically paying you to take the metal away from them before the whole thing implodes. So here's the verdict. We've laid out the battlefield map. We've shown you the arbitrage bomb, the $20 spread acting like a massive vacuum cleaner, sucking every available ounce of metal from west to east. We've shown you the dollar collapse, the DXY crashing below 96, proving that the reserve currency is vulnerable. We've shown you the margin desperation, the COMEX hiking the requirement to 51,000 just to force traders to fold their hands. And we've shown you the refiner reality. PAMP Swiss confirming that despite the paper price drop, physical factories are running hotter than they have in decades. The conclusion isn't a guess, it's a mathematical certainty. We are in the endgame of the dollar standard. You cannot have a market where the same asset trades for 106 in New York and 126 in Shanghai indefinitely. That's not a market, that's a crime scene. That spread represents the bleeding of the American empire. Every day that the spread exists, another 1,000 bars leave the vault and fly east. Every day the West gets poorer and the East gets richer. The COMEX has backed itself into a corner with no escape. They have two choices left, and both are fatal to the status quo. Choice number one, they admit defeat. They let the price go. They stop the suppression. They stop the margin hikes, and they let New York gap up overnight to match Shanghai. If they do that, silver jumps to 130 tomorrow morning. The shorts get wiped out. The banks lose billions, but the market stays open. Choice number two, they keep fighting. They keep the price smashed at 106. They keep pretending the shortage doesn't exist. If they do that, the vault hits zero. Registered inventory goes empty, and then they have to declare they don't have the metal. The moment they say that, silver doesn't go to 130, it goes to no offer. It goes to a place where your dollars are no longer accepted as payment for real things. We are watching a game of financial confrontation between institutions and the laws of physics. Physics is going to win. The $20 gap must close, and it's not going to close with Shanghai coming down. Why would they lower their price? They're the buyers. They're the ones with the cash. It's going to close with New York exploding up. So this is my final warning to you. Do not get shaken out by the volatility. Do not let the $51,000 margin hike scare you out of your position. That hike is not a sign of strength. It's a scream of weakness. It's the sound of a system that's out of options. They're trying to trick you into trading your silver, the only asset flowing toward the highest bidder for dollars, the asset crashing against everything from the Swiss franc to a loaf of bread. Do not save dollars. Do not hoard cash. Cash is the victim in this situation. The window to act is closing, not because the price is rising, but because the metal is leaving the continent. If you want to be on the winning side, you need to do what the victors are doing. You need to hold the metal. Let the banks play their paper games. Let them short each other. You hold your ground. You watch the spread and you wait for the inevitable morning when the COMEX breaks and the true price of silver is revealed to the world. The spread is $20. The vault is draining. Hold the line.